It is still one of those expensive lessons from my first 5 years of angel investing. Early on, I followed some more seasoned investors into a deal and increased my check size to match theirs. It didn't turn out to be a great investment, and I shouldn't have followed them into the deal, but I didn't listen to my own gut instinct. Hi, I'm Rupa Poppet, the founder and managing partner of Araya Ventures and the House of Araya. In my first 5 years of angel investing, there were 5 key things that I wish I'd known. I'll start with number 1, which was the founders. It is all about the founders. And what I mean by that is I spent so much time in those early days looking at the market sizing, the competition, going really deep into the competitors, going really deep into the product and the product roadmap. And yes, of course, all of those things are important, but ultimately when you're investing at the earliest stages like we do, it's all about the founders, and it's about why those founders, why now, why in this market. And so actually, I believe now that you have to spend a disproportionate amount of due diligence time on the founders themselves and what makes them the founders that you want to back. I've talked about this quite a lot before, but a founder journey is never linear, and there's always lots of highs, lots of lows, and there's lots of resilience required to continue to strategically pivot, scale and grow. And so ultimately, even if it's the best idea and they've built the best product, without having the right founders then building and scaling that company, it just won't work. And so I spend now a disproportionate amount of my time focused on the founders. The second thing is second guessing myself. In my angel portfolio, I've got one loss that happened, which I've talked about in another one of my videos as well. When I had that loss, I started to second guess my ability as an angel investor to be successful. When I went into that investment, I truly felt that all of the market trends and that particular founder was the right founder to be building that company in that moment, in that time. It started to make me second guess why it failed and what I did wrong. But actually, angel investing is about failures, because you have to have enough companies in your portfolio to have 1 or 2 outliers. But what's going to happen to the rest of them? There will be failures within the portfolio. And so that's a key part of building a successful angel investment portfolio. And so realizing that the loss is actually an actual outcome you should expect, as opposed to being something that makes you reconsider whether you're a good investor or not. And so actually one of the things that I went through after that loss was go back to my notes of why I invested in the first place. Would everything that I looked at and the reasons I invested still hold true today? And the answer was yes, they did. And so I can kind of look at that as part of my overall portfolio construction, as an important part of the angel portfolio, as opposed to being something that, I should reconsider, the process in which I took to do that due diligence. The third thing is what I call the value add. And I don't say that lightly, because I think over 90% of investors say that they are value add to their founders. And I think founders say about 60% of their investors are value add to them. But I really underestimated how much impact me as an individual angel investor, or now even, us as a firm, Araya, can have on our founders and on their journeys and trajectories. And so really understanding the value that we can bring to, or, each of us individually and collectively can bring to the founders that we back, is something that I really underestimated in my early days. As I got to build my portfolio and understand what I could add to those companies, I really was able to start understanding where I might be able to help move the needle for a founder. And then as I got to meet the next set of founders, I was able to articulate to them where I think I could add value to them beyond the capital. And that's essentially quite a big part of angel investing, is not just putting in the check, but it's also what can you potentially do afterwards for the founders that could help them in some meaningful way. The fourth thing was quite underestimating some of the terms in the term sheets. I had invested quite early on in, I mentioned before in videos, but I invested in one company, then I did 2, 3, 4, 5 quite in succession. In my first company, there was a VC fund that was leading that. And so I didn't really have to worry about the details of the term sheet, because that was what they were taking care of. And I was piggybacking essentially off that. And that's something obviously that we do at House of Araya as well, as we make sure that all of our term sheets are seen by our law firm prior to going ahead. And those are the deals that we then bring into the House of Araya to our members. But My deal number 2, 3, and 4 didn't have a VC fund on the cap table, which meant that it was up to me essentially to make sure that those terms, were correct and were protective essentially. One of the things that I did notice during that journey is that when you back a winner, you really need to have the right terms in the term sheet to enable you to continue to back that winner in future rounds, for example. Or when things don't go well, you really need to know that you're in, the best share class possible to get at least some of your capital back, for example. So these are the things that I probably underestimated in those early days, which obviously have got much better at over time. And obviously with Araya Ventures, we have actually a whole legal in-house, external but in-house process that we do for all of the deals that we enter into. And so that's definitely something that I had underestimated on the way in. Fifth one is angel investing has a lot of FOMO inherently in it. You meet an inspiring founder. Other investors are talking about how they're going to back that founder and that team. There's a lot of excitement and buzz around it, how it could be the next big thing or the next big category creator, as we talk about, which is what we're all looking for. Sometimes that FOMO can take you away and kind of attract you to putting that check in and that investment. So very early on, I had FOMO in a deal. I had been looking at an opportunity that was brought to me from one of my trusted networks. There were a lot of other investors who were going into that investment as well. Many of them had been investors for years longer than me, one of them even a decade before me. I had really good, successful outcomes as well. And so I was very much swayed by their input as much as my own. At that time, my gut was actually telling me not to invest, but I got caught up in the excitement of all of the other investors who were going in, the pedigree of those investors, how long they had been around versus how long I had been around, and I went ahead with the investment. The investment hasn't done really well. It's definitely not one of my top 5, 10 performers in my angel portfolio. So it was definitely an early lesson for me in trusting my gut instinct and, angel investing very much being, yes, the science, we do the due diligence, we run the numbers, we look at the market landscape and the market sizing and the competitive landscape, but then also the art. And that's the piece that you can't always put your finger on, which is how you feel when you're in the room with that founder and how you feel about the potential for that specific company. So just in summary, number 1, I wish I'd realized earlier, it is all about the founders at the earliest of stages, and that is the most important thing that we're looking at in those early stages of due diligence. Number 2 is about losses and second guessing myself. Losses are just a part of angel investing, and they are a part of what will happen in your portfolio if you're doing it correctly as well. So not to be something that you second guess yourself for, but actually to embrace it as part of what your portfolio will be doing. Number 3 was value add and understanding the true power of what angel investors can do when being on a cap table for their portfolio companies. And number 4, underestimating the terms that matter most when things go really well, but also when things don't go so well. And number 5 is following your own gut instinct and very much embracing the fact that there will be deals that you pass on. You feel like everybody else is going in, but making sure you stay true to what you feel should be in your portfolio. I want to share with you something that we've built specifically for investors who are already deploying capital. It's a diagnostics questionnaire at House of Araya. 12 questions, 4 minutes. It gives you a personalized read on exactly where your investment process is breaking down across deal evaluation, portfolio construction, the quality of your access, and your discipline when the pressure is on. Most people who've done it have told me that they found something they didn't expect. This will give you a really honest read on where you actually stand.